Hi everyone, it's Dan here. In this video, we're going to look at the stock of three of the big tobacco giants: Philip Morris International, British Tobacco, and Altria Group. If you're new to the channel, my name is Dan. I'm a business school professor focused on accounting and finance. The purpose of this channel is to help you build your wealth through saving and investing. So if you like money, hit that subscribe button. So why should you consider investing in tobacco companies? Well, for one thing, they have an enviable business model. Their products are literally addictive, and they cost very little to manufacture, giving them extremely high gross profit margins. Another good thing about the tobacco companies is that they pay out a huge portion of their profits every year as dividends. Philip Morris is currently yielding about 6%. British American Tobacco is yielding 8%. And Altria Group is yielding 8.66% right now. Now, compared to a treasury bill or a corporate bond, these are incredible returns. So if you think about it, if their stock price manages to just stay the same, you're receiving about an 8% yield. That's quite an incredible return. Now, there are two reasons why a lot of people simply won't touch tobacco stocks. For one, a lot of people just have a moral problem with profiting off this kind of business. The number two reason is that it's an industry that at best is in a steady state. Most would say it's an industry in decline. As you may have picked up from some of my other videos, I do view the stock market right now as being in a bit of a state of euphoria. I see a lot of people really just focused on the next stock that could make them a millionaire overnight. People are very focused on growing companies right now, and so I do believe that the tobacco stocks are just not being paid any attention. Consequently, this makes tobacco stocks an attractive investment opportunity right now. It's a great defensive play as well because these stocks are more or less recession-proof. So I'll start off the analysis just by looking at some price-earnings ratios. So here's Altria Group, ticker symbol MO. And if you look at the price-earnings gap forward ratio, got a value of about 9.7. Compare that to British Tobacco International, BTI. Their forward price earnings ratio is 8.67, a little bit better. And then we have Philip Morris International with a price earnings ratio of 15.88, much higher. So just looking at these PE ratios, Philip Morris seems to be a much worse deal. But while the PE ratios make Philip Morris look like a much worse value, we have to consider that Philip Morris International operates in many other countries, some of which are actually seeing growth in cigarette usage. In contrast, Altria Group is largely based in the United States, and British Tobacco has about half of their operations in the US. So with the decline in cigarette usage in the United States, this is something we have to consider. The thing about Philip Morris is, though, when I look at their growth, for example, here is their revenue growth last year, year over year, negative 1%. Their forward estimate revenue growth is about 1.19%. I'm really not seeing any tremendous growth that would justify such a high price earnings ratio. If we compare those growth metrics to the other competitors, we see that they stack up quite poorly. British Tobacco International is growing at 3.8% for their revenues. They're estimating a forward growth rate of 1.9%. And even Altria Group, based in the US, has revenue growth last year of 3.37%, and they're predicting about 2% going forward. To take a deeper look, the next thing I'm going to do is figure out the intrinsic value of each of these companies using a dividend discount model. The dividend discount model approach is really perfect for cigarette companies because they are mature and stable businesses, and they pay out close to all of their profits as dividends, making this model really work well for these companies. If you like the content so far, please hit that like button. It helps me a lot. So to make the dividend discount model work, we need to estimate future dividends, a discount rate, and a growth rate. Now, estimating the future dividends is actually pretty easy for these companies. They all have a strong record of increasing dividends. Altria Group, for example, is a dividend king. They've increased their dividends for 51 years in running. Estimating the discount rate and the growth rate is a bit trickier. The thing about the growth rate here is we have to consider that it could be negative. Now, so far, that hasn't happened. Tobacco companies have managed to maintain or even increase their earnings by having price increases to offset the decline in volume. Can they keep that up indefinitely? I personally don't think so. I think we should be careful when estimating that growth rate. Now, with a discount rate, I would normally use a very low rate, given the low risk-free rate being offered right now. But I think these companies face some additional risks, and I may have to increase that rate a little bit to reflect that. Okay, so let's look at the value depending on the cost of equity I'm choosing, also known as the discount rate, and depending on the growth rate I choose. So Philip Morris, we'll start off with Philip Morris. They trade about $80 a share. And for example, if I choose a 9% discount rate and a negative 1% perpetual growth rate, the intrinsic value would be $48. That's the most pessimistic scenario. Using a more liberal 6% discount rate and a 3% perpetual growth rate, the stock could be worth as much as $160. So this little chart right here gives you a sense of what the value of the stock is depending on the assumptions you choose. What I'm seeing here is that it is, if you look kind of in the middle area, the stock is fairly priced, for example, with a 7% cost of equity and a 1% perpetual growth rate. So I don't see any deal there with Philip Morris. Moving to Altria Group. Altria Group trades at close to about $40 as of the time I make this video. And that appears to be a good deal under almost any assumption except the most pessimistic ones. So that seems like it could be a good deal. Let's look at British Tobacco International, BTI. They're trading at around $33 a share at the time that I make this video. And kind of like Altria Group, you see that that's going to be a pretty good deal under almost any scenario except the more pessimistic ones. It could potentially be an extremely good deal if they're able to keep up that revenue growth. So one last thing I like to look at is insider activity. The insiders would be the executives and the people on the board of directors. They surely know more about how the company is going to perform in the near future than we do. So when I look at Altria Group over the past 12 or 3-month period, I see quite a few more shares bought than shares sold, especially over the most recent 3-month period. That is an encouraging sign. When I look at Philip Morris, I still see a lot of buying over the past 12 months, but quite a bit of selling as well. And over the last 3 months, we don't have anyone buying shares, and we have quite a few selling shares. Now, unfortunately, insider data on British American Tobacco is not available. So far, Altria Group and British Tobacco seem like the better deals compared to Philip Morris, and this only solidifies it. When you look at their debt-to-assets ratios, they all use quite a bit of leverage, tobacco companies do, which is typical of a mature company. But Philip Morris's debt-to-assets ratio is over 100%, making them a lot riskier in the long run. Debt never goes away. You're going to have to pay this off at some point. Altria Group sitting at about 88% debt-to-assets ratio is also pretty high. BTI is the only one that looks healthy to me. Then you look at the payout ratios. The payout ratio says, what's the dividend divided by the net income? So out of all the profits you make, how much do you pay out? Now, Philip Morris pays out close to 100%, and that may seem generous, but that makes their dividend unsustainable in the long run. Whereas when I look at BTI and Altria Group, theirs is a lot more sustainable. Okay, so here's a few qualitative factors to consider to finalize your decisions. One thing to note is that Altria Group owns about a 10.2% stake in Anheuser-Busch. That's a company valued at about $114 billion, and they own 10% of it. That really helps diversify them. They also have a 45% stake in Cronos Group. That's a $2 billion company focused on marijuana. And they have a 35% stake in Juul, a vaping company. So taken together, Altria Group has done a lot to protect themselves from declining cigarette sales. But with Altria Group based entirely in the United States, I still see significant risks. The U.S. recently raised the legal age to purchase tobacco from 18 to 21 just last year. This could have long-term ramifications. You think, a lot of people may start smoking at those ages, 18 or 19 years old, and now they're not going to have the opportunity to buy that anymore. So Altria Group may be missing out on lifetime customers here. I'd be much more comfortable with British Tobacco's position, having about half of their operations in the US and half abroad. As well, when you look at the debt ratios and the dividend payout ratios, it's pretty clear that British Tobacco is the winner here. So that's my recommendation if you're going to buy any of these: British Tobacco International, BTI.